If you're in the mood for a quick update of how stocks and bonds have done so far in 2023, this is the video for you. In addition to going over how stocks and bonds have done year to date, we'll explain why long-term bonds are paying lower interest rates than short-term bonds, what interest rate risk is as it relates to bonds and why it's important for you to know, and why we think physicians should not only be investing in domestic stocks, but also in international stocks. Welcome to Wealth Matters for Physicians, brought to you exclusively by Altfest Personal Wealth Management, the channel that provides physicians with key investing and personal financial planning strategies. For 40 years, physicians have turned to Altfest to help them plan financially to gain the financial security and future they deserve. We can do the same for you. My guest today is Ryan Graham. Ryan is a managing advisor at Altfest, where he advises clients on all aspects of their investment and personal financial planning lives. Well, Ryan, thank you very much for being with us again today on Wealth Matters for Physicians.
Thanks for having me again. It's great to be here.
Excellent. Well, let's get right to it. Today, we're going to be discussing the year-to-date performance of the financial markets as of the middle of the third quarter of 2023. So Ryan, to kick it off, where does U.S. stock market returns stand today?
Yeah, so thankfully things have been rather positive, and I'll just share a chart here about where returns stand. This chart actually shows the last 12 months for a broad range of stock market indices. So for example, this purple line you see here, which was up 26% over the last 12 months through the end of June, that is the NASDAQ, which has performed very well, especially this year. All of the gains over the past 12 months have come in 2023. And this index is composed of primarily large cap growth or technology companies, many of which, a lot of physicians will be familiar with, Apple, Google, Tesla, these types of companies. So that's been a very strong part of the markets. Meanwhile, there have been other parts, and just so you can see this a little bit better, I'll zoom in. There have been other parts that have not performed quite as well. A key one being emerging market stocks, which is this green line here. Over the last 12 months and this year, it's been barely positive for those emerging market country stocks. And then many markets are kind of somewhere in between, still nicely positive over the last 12 months, in some cases close to 20% for some of these broad market indices. So overall, definitely a very meaningful improvement to the start of this year compared to where we were at in 2022, which was a much more difficult year for the stock market.
Great, thank you. Wow, you could really see some difference between the various asset subclasses. And so, when we talked about stocks, how are bonds doing year to date?
So bonds are another area where thankfully it's been a brighter picture this year. So for many types of bonds, you've seen, slightly positive, low single digits or maybe mid-single digit returns the first half of 2023. Just as an example, this year for 2023, you can see that a 30-year treasury year to date has delivered a close to 3.5% return there. And all this said, we're also at a place where yields are much higher. So for example, on a shorter term bond, you can get close to 5% on a 2-year treasury, which is very different than what we saw over the past basically decade, where you would, in many cases, not see this figure much above 1%, let alone 5%. So we are in a much different environment now.
Great, and that brings up a question that probably some physicians are thinking about as they see this chart, which is, longer term bonds seem to be having, in general, like lower interest rates than the shorter term bonds. Isn't that not usually the case? What's causing this? And is this meaningful for an outlook on the future?
Yeah, I think it is meaningful. And I think a lot of our clients, and many of which are physicians, see this, for example, if they're looking at CDs as an example, where you can get a higher yield on a shorter term one versus longer term one. The same applies for treasuries, where you can see here the shorter term yields are closer to that 4 to 5% range as of June 30th, and the longer term yields are a little bit less than 4%. So not an immaterial difference. And the reason that this can exist is that the market generally believes that interest rates are coming down going forward, which is something we talked about in a previous conversation, in a previous video. And because of that, they're willing to accept a lower rate of return for a longer bond, just because they know they can lock it in for that period of time. And we call this an inverted yield curve, where the longer dated bonds have a lower yield, annualized yield. And this, in many cases, has been associated with a recession that could be coming. So it is something to consider when constructing a portfolio. Of course, we're paying very close attention to this dynamic and determining kind of which end of the interest rate curve is a good place to be.
Excellent. Thank you very much. It's interesting to get that explanation because you don't see that every day. Still staying on bonds, I know that for educating our physician audience, they might hear on the Financial Times or the press, in media, television, print, about interest rate risk, bonds and interest rate risk, but maybe not have the best understanding of that. So could you explain a little bit what is interest rate risk and as it relates to bonds, and why is this important to be aware of?
It's a confusing term, right? I mean, interest rate risk, it sounds like what's risky about collecting interest. I think the term really is trying to get at the fact that interest rates have a very direct relationship with the price of bonds. And just to give everyone a sense of that, this diagram gives us a sense of the magnitude a certain rise or fall in interest rates can have on the price of a bond. In this case, just to highlight an example, for a longer term bond, like for example, a 30-year treasury bond, the interest rate risk is much higher than a shorter term bond, which we'd consider have a lower interest rate risk. And we can see that with the magnitude of these bars you see here, where a 1% rise in interest rates can have a very negative impact on a longer term bond. Like in this case, hypothetically, it could go down close to 14% for this bond if interest rates rise by 1%. Meanwhile, on the flip side, if interest rates fall by 1%, you can actually see a very positive result for a longer term bond. So that relationship between interest rates and price is a very direct and meaningful one. And it should be carefully considered when constructing a bond portfolio to make sure you're comfortable with the interest rate risk that you're taking by investing in longer versus shorter dated bonds.
Right. It's really interesting. So when you're talking about interest rate risk, it's right. What is the risk to current bonds if interest rates change?
Exactly. Yep.
Excellent. Excellent. Thank you, Ryan. And now changing the subject a little bit, we have a question that we often get from our clients, including many of our physician clients. Some people have some concerns about international stocks. They're like, well, I'm a little bit worried about them. There's a lot of global macroeconomic things happening in the world, China and Ukraine, Russia, things that might be happening in the Middle East. And so that maybe I don't really want to have so much international stocks in my portfolio. Does it make sense to just have US domestic stocks, or do international stocks, do we think it plays a good role in a physician's portfolio in general?
In general, I think the short answer would be, we do believe it has an important role in the physician client portfolios we help manage. And I think the concerns are very valid around investing internationally. You have maybe more risk by investing in international companies in a couple of ways. Geopolitically, of course, there can be concerns in any given year. There's so much going on around the world that can be have its own risk. And then also there's a currency risk with investing elsewhere that, you're not always investing in companies that buy and sell in US dollars. So there can be risk with changing currency movements, but that's probably a topic for another day. I think maybe the one thing I'd like to share is that there can be very pronounced cycles of performance for US versus international stocks. So recently, most of recent history, let's call it 14 years, US stocks have strongly outperformed international stocks. So we see that here, where it's been a pretty meaningful outperformance. 277% better than international stocks. That's a big number. But we've seen parts of the past few decades where international stocks have delivered very meaningful outperformance. And as a physician that is saving, whether in your peak earning years or as a physician that is approaching retirement, especially, it's not a great thing if you're caught off guard by being fully invested in, say, US stocks during a period like this one, where international stocks are outperforming by close to 300%. We believe having a good core US stock base in the portfolio is important, but even more important is diversifying around that. And especially international stocks, we think at the moment represent good value and may have their day in the sun here. And you might see another cycle where they do outperform. And that's why we think it's important to be diversified, because you never know the extent of which that cycle will occur. You don't want to be caught on the wrong side of it.
Right. Another example of the benefits of a diversification. No one really knows when any asset subclass is going to shine or not shine. So it's good to kind of hedge your bets.
Yep. You got it, Mike.
Excellent. So, well, thank you so much, Ryan, for being on the Wealth Matters for Physicians YouTube channel today. I mean, we really appreciate it. And I think you've given our physician audience a lot of good things to think about.
Thank you, Mike. Looking forward to our next discussion.
Sounds good. If you'd like to discuss the information explained in today's video, receive a complimentary review of your investment portfolio, or a retirement readiness analysis, or discuss any other personal financial planning area with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732, or by emailing Jesse at his email address, which is also in the description of today's video. If you like today's video, please click the subscribe button below and hit the bell icon to receive notifications each time we release a new one. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them optimize their finances. Lastly, as always, if you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you. So please give us your comments in the comments section below. Well, that's all for today, physicians. Thank you very much for watching today's video, and I look forward to being with you again in our next one. Until then, be well, and remember to keep on optimizing your finances, or let us help you if you'd like.